Hi there, this is Mitch Firestone with Precision Trading Labs in New York City. I am here with you to bring you the market wrap-up for May 12th, 2023. Here's the battle plan for today. I'm going to be talking to you about the SPY and the QQQs, along with the IWM. We'll talk about them in the context of both the the last trading week as well as the last rolling month. We'll then take a look at the strong and weak sectors for the last week and see, where there are pockets of relative strength and relative weakness, as well as talking about potential strategies to employ, knowing that. We'll then take a look at very specific levels where we might consider buying and selling, looking at the SPY and the QQQs. And then we'll actually look at a few symbols that a number of our subscribers look at commonly. And so we'll take a look at some specific levels in those charts. We'll analyze where we are in relation to those in terms of where current price is, and then in connection with their distance from the potential zones. And we'll also talk about a couple of strategies in some of the charts about how we might utilize that information. So that's the battle plan for today. Before I get going, the ubiquitous disclaimer: Precision Trading Labs, we are not financial advisors, we are not fiduciaries, we are not financial planners. Everything that we present to you is in the context of information and education. Okay. So anyway, let's take a look at the charts and get going here. So last week, what we're looking at right here, this is a percent change chart for the last trading week. This is based on the close of prior Friday, May 5th. And so this is the last trading week, okay? And so this is all based on a percent change from the close of the prior Friday. And we can see it was a relatively quiet week. When it all came down to it, the Nasdaq was up about 2/3%. The Russell 2000 was down about 1%. The SPY was pretty close to flat, and we also have the bond market in here just for some comparison. So we can see everything was range bound within plus or minus 1%, and this is actually pretty consistent what we've been actually seeing for the last 3 or 4 weeks. If we go back another week here. This is the prior week, and so we can see the Nasdaq, everything was down just a little bit. In terms of the equity markets for the prior week, same thing. The Qs were flat. The Russell 2000 was down 0.5%. The SPY was down less than 1%. So again, a quiet week. And if we go back one more week, we'll see here that the Nasdaq was up about 2%. The SPY was up about 1%. The Russell was down about 1%. So really, though, we've been fairly range bound, and the prior week was similar. So really, what we've been pretty range bound for the last month, and to some degree, this might just be the calm before the storm. And the longer this goes on, it's it's the calm before the storm. And what we really are probably looking at here, to some degree, even though you can't explicitly say this, but of course, it's the 800-pound gorilla lurking in plain sight, and that is the debt ceiling negotiations, or in a sense, the lack of negotiations. And so, to some degree, where you might just be looking here is that the market is just, to some degree, almost in a holding pattern, waiting to see what's going to happen, and whether the lunatics in Washington are either going to torpedo the full faith and credit of the United States government by not actually paying our debts on money that's already spent, or in fact, whether they actually will negotiate in good faith. Forgive my cynicism, but the good faith seems to be a rare commodity there. So to some degree, where everyone's waiting to see what's going to happen with that, and if in fact that they do torpedo our credit, you're probably going to see a real nice market smackdown there. On the other hand, if they do in fact negotiate and at least have a continuing resolution and at least kick the can down the road a little, where there's some faith that maybe they're not going to torpedo everything, then you might actually see a relief rally out of that. So this is all supposed to come to a head maybe the beginning to mid-June, depending on when the U.S. is going to run out of money, if in fact they don't extend our credit. So we're going to see what happens with this. But this is kind of the like I said, this is the big deal that's kind of holding in plain sight there. All right, so that's what we're kind of waiting on here. If we go back to the charts here. This is what went on last week, and this is the what we're looking at from the perspective of the 13 major sectors. Okay, so we can see right here that the communication sector was up about 2.5% last week, and the weak sectors from last week were materials and energy, and then everything else, of course, was kind of clustered in the middle. And we could see that at the top there's the consumer discretionaries, and at the bottom, the transports, and these are kind of like the middle, the mid-range, the middle sectors. And so everything is kind of clustered within this 2% range here. And then, of course, right here is the SPY, and that was, that's just down, just a bit here. So that's the story from the sectors for the last week. And so we might be looking, this week to see if the communications are actually going to maintain their strength. And so, there might be some potential breakout trades that can be employed there. On the other hand, if there are some minor pullbacks in lower time frames, we might be looking to go long within the communications. If in fact, let's say Monday or Tuesday, we end up with some pullbacks into some trading zones that I'll actually show you in a minute or so. So that's the story with the various sectors. And then, of course, with respect to materials and energy, we might be looking at the exact opposite, perhaps looking for some bearish trades that we can employ based on this relative weakness here. Okay. If we then go to the last rolling month, we can see, of course, that what sticks out here is how weak energy has been. So this is the last rolling month. Okay. This is the last week. Excuse me. This is the close of last week. And so this goes back to October, April 7th of this year, and that goes back 5 weeks. Okay, and that's what I refer to as the rolling month here. Okay, and so this is the last 5 weeks. So that's approximately the 25 trading days or 24 trading days if there happens to have been a holiday in there. And so that's 24 or 25 trading days. That's the last rolling month, and we can see, of course, that the consumer staples, and interestingly, consumer staples and consumer discretionary are both sitting at the top. That's actually kind of unusual, because usually the consumer staples, and the consumer discretionary, they tend to be fairly wide apart, because consumer staples are when there's sort of a contraction and some risk off sentiment is occurring, and while consumer discretionary or consumer cyclical, depending on how you want to phrase it, that tends to be more of a risk where there's risk on. And so as a result, to have them sort of sitting together is kind of unusual, okay? Because usually consumer staples goes along with utilities and healthcare when they're in a risk-off situation. So again, to see them kind of sitting at the top there together, it's actually kind of an unusual confluence there. But anyway, so these are the two strong sectors for the last rolling month. And again, energy by far, of course, is the weak sector down here, okay? And that's down about 8%. Okay, so really, we're really, in terms of energy, either looking for breakout trades with energy when those setups present, or if in fact we find pullbacks into what we refer to as supply zones in order to then go short. That's another way, of course, that we can express a bearish trade with energy. But whether we're looking at the last month, the last week, or the last rolling month, they are both very, very bearish with energy. So that's kind of the way we're looking at this here. All right. If we now go to the live charts here, and we start out with looking at the SPY, here's where we are on the SPY here. And let me just spread this out just a bit here. Okay. So this is where we've been. And in fact, actually, let me show you a prior chart here, which actually kind of give you a perspective on where we've been here. Okay. So this is where we actually were on April 21st. Okay, so this goes back about 3 weeks here, 3 Fridays ago. Okay, and so this is where we were looking last 3 Fridays ago, and what we were looking at was this zone here where there was a consolidation and then a bullish pop out of here that basically came out with a great deal of energy. There was a very bullish candle. Price came up, okay, and then we were waiting for price to return to this level here, and we were going to use that as the basis for a long trade here, okay. And so this is where we were kind of looking to see where were these zones in relation to that current price there. So we can see that was about 2% below where current price was on April 21st, okay. And so if we look right here, this is where we were, and then if we then flash forward the following week, we can see that, in fact, price came right down here and then rebounded nicely off of that, okay? And so at that point then, this was the basis of some bullish trades that we had shared with our subscribers, either buying the SPY or really, because of the fact that it's such an expensive share price, to actually buy either long calls or do a bull call debit spread, or in fact do a bull put credit spread as well. Okay, and those would all be different ways of expressing that trade. Okay, so that was what went on the prior week. Okay, and now if we look at the week that just concluded, we can see, in fact, that price came back to this level yet a second time and again rebounded, and that's where, of course, we finished the week. Okay, and again, the same kind of thing was the same way we could talk about in terms of expressing a trade here. Okay, and so basically doing a bull call vertical spread here, and of course, again, one could also have done a bull put credit spread. Okay, so that would be another way of expressing that trade. So you could either buy a call, do a bull call vertical spread, or again do a bull put vertical spread for a credit. So those would be all different ways of expressing these trades coming off of this demand zone. Okay, and the reason that we call this is a demand zone here is that price consolidated here, supply and demand for shares within this range of about $2 here, from 401 3/4 to 403 3/4. Within here, there was a consolidation where supply and demand for shares within this relatively narrow range, they were in balance. And then they went out of balance. And the way they went out of balance is that essentially there was an exhaustion of sellers here. The sellers disappeared. And in order for these trades to have occurred, the buyers had to run up the price chart until they encountered willing sellers. Okay, so that's how these trades occurred. And because price spent a relatively small amount of time in here, and the fact that price came out of here with a great deal of energy, small pause, and then another pop or another bullish candle, there was the expectation that there was still what we can think of as upward price pressure that was still sitting in this zone. Okay, and that was essentially waiting to be tapped. And so that was the basis for these two trades that transpired after we had identified this zone 2 weeks prior, which was there. Okay, so that's essentially the underlying principle of what we were looking at. Okay, so that's what went on. And then similarly, we could actually see right up here, there was also a similar occurrence when it came to an area of supply. Okay. And so that's, in fact, I'll show that to you in the live chart here. So let's move on to the actual live chart here from these slides. And so this is where we are now. Okay, so this is that area where we had that area of supply, and it was the same narrative of what I talked to you about on the demand zone side, except this is an exhaustion of buyers here rather than an exhaustion of sellers. And so when price came back to this region, again, price spent little time in here, and so price got kind of swatted down from here. And so this would have been the basis for bearish trades. Okay, and so of course, to express a bearish trade up here, we could have simply bought a put, done a bear put vertical spread for a debit, or of course sold credit via a bear call spread. Okay, and so that would have been a way when one could have expressed the trade. Okay, again, price came back to this region on the 28th or thereabouts, and so again, that was another occurrence really at the same level where one could have expressed that trade. Okay, so then we've been sort of range bound since that occurred. This is where we are now. So in terms of levels, I'm actually not enthusiastic about shorting up here anymore because we've already been back here twice. And on a retest, I'm really not enthusiastic about that level. Okay, because it could be that all the supply has already been chewed up and there's no downward price pressure waiting to be exploited. So at that point, then I would be waiting for the next level up. And that next level up is kind of sitting right in here. We're looking at a daily chart here, but if we broke this down into a 2-hour chart, there is some supply up here. And so at that point, then this is where we would kind of be looking to, again, express the trade pretty much in the same ways that we were looking at up here, but doing it at a higher price level. So if we look up here, this is where we are now, and that's where that level is. So that's about 2.5% up, okay, on a 2-hour chart. And then if we go up here further, when we look at the daily, we can see that we can see that we have a daily zone of supply, again, where there was an exhaustion of buyers here. We can then look up and see that that's about 3.5% up. So you can see that various trading zones are sitting relatively close. They're not sitting way out 10% up or 10% down. They're relatively close in. Consequently, I still think, as long as there isn't a major move regarding, let's say the debt ceiling, we might continue to be range bound, at least for the next few days or the next week. But of course, we'll see. So here's where we are with respect to current price. Again, these are the range. This is where the supply zones are above. And then in terms of demand, this is about 2% down. This is about 3.5% down. This might just, so twice we've gotten a nice bounce out of this area, and we might just get a third time. Even though I'm not enthusiastic about repeated tests of a zone, if we blow this up and take a look at it, we can see that both times it's just kind of kissed the front level. In sports terms, this is almost be considered to be kind of incidental contact, right? So this has barely touched the zone, and it's done it for a very brief amount of time, and it's barely penetrated at all. Consequently, when price comes back here again, you might just get another bounce out of this supply zone. And of course, this can also be thought of at this point as sort of a point of resistance as well. So that's the deal with the SPY. And again, that's the next clean level that's never been touched. And that's about 3.5% down. Okay, so that's what we're looking at with the SPY. If we turn to the Qs, here's where we are on the Qs. And in terms of the levels where we're at, let me just spread this out a little here. The next level up is about 1% up. Okay, and if we go to the left here, we can see that's more or less that same daily zone we saw on the SPY. Okay, and so that's what we're seeing here on the Qs. And then if we actually then drop down below that, that's a level of supply up here. Okay, down here, this is an area of demand here. And this is about 5.5%. This has already been chewed up, so I don't think I don't really like that. Right here, there's an area that's already been chewed up again, and price kind of drove through this. So I don't think this is any good. This right here might actually be a lower time frame zone. And it didn't really break out well in the 2-hour. I would look at it and see if there might be something in a 30 or a 60-minute chart. I'm generally not a huge fan of those levels in terms of swing trading levels, but that certainly would conceivably represent a good intraday level for a very short-term trade intraday. So right in here, that's sitting at around, let's say, the 316 mark, from let's say 318 down to about 315.15. So this is about a 2.5 point level, a potential level somewhere in here. So we'll certainly be taking a look at that in our subscriber room this week. So that's that level here. Again, really, there's nothing here that I like. So really, at this point on the Qs, this is kind of a much wider range than we're looking at on the SPY here, because this level on the Qs here is about 8.5% down. So really, there's kind of this short-term level here, about 2.5% down. And then in terms of a clean swing trading level, this is a fair distance away. So we will certainly be keeping an eye on that. If we turn to some symbols that a number of our subscribers like to look at, and then as well as us, here's Apple. And if we kind of break this out again, here's where we are right now. this actually has driven into an area of supply here. And this supply zone has stopped price from rising, but it really hasn't sent it down yet. It's just kind of hugging this level here, and it's kind of pushing against it, but it hasn't broken through it, but nor has it been sent back down. So, we'll kind of keep an eye on this. But the next clean level of supply up here, if this would actually break, is sitting up here at around 3.5% higher. And again, if we swing to the left of the chart here, we'll see right there. This is a level that kind of sits in a 2-hour chart here. It kind of kissed it and went in there once before, and now we're waiting to see if it perhaps comes back there again. And that's 3.5. That's about 3.5% done. Ideally, we really don't want to be taking a level the second time after it's hit it the first time. But because this was there briefly, we'll see how it behaves when it gets up there. If it shows that it has the potential to drop again, looking at a lower time zone, and we see a very bearish candle that starts to emerge here in a lower time frame, let's say in a 2-hour, we might just look at a bearish trade out of this level yet again. But we'll see what happens there. Then in terms of Apple, looking at these 2-hour charts below, let me just spread this out here. These are both 2-hour levels on these. These are daily pivots. But if we look at these in a 2-hour chart, there is some evidence that we can see where price is actually consolidated within this daily pivot. And so as a result, we might be looking at points of demand in a 2-hour chart, roughly 3.5% down and a little less than 6% down. So that's there. And then right here, this is really not a clean level here because this is kind of reacting to some demand over here. So I'm really not enthusiastic about that. But within here, within this range, there's probably some basis for a bullish trade out of this level here. And that's sitting here, if I just turn on the labels here for a second. So that's sitting here roughly at about 166, let's say 166.31, and at the bottom here, 162.71. So we can see this is approximately about a $4.60 range between here and there. So that might be a place where we could be looking at expressing a bullish trade out of this region. Okay. If we look quickly at Amazon, so here's where we are on Amazon here. And actually something interesting I want to point out to you, we are now we're getting close to sitting midway between supply and demand here. Okay, so right here, this is probably a 2-hour supply. This is a 2-hour supply zone up here. Okay, and then if we go over here, this maps out to a 2-hour demand zone. If price comes up here just a little more, where it's literally sitting in between, this is actually an ideal scenario to actually do an iron condor. And for those of you who don't know, an iron condor, we talked about a bull put. Let's say we talk about a bull put credit spread down here and a bear call credit spread up here. If you put both of those on simultaneously, that's what an iron condor is. The reason it's called that, if you look at the profit loss chart, it looks like a bird of prey. But that's an iron condor. So again, it's just the credit spread above and a credit spread below put on simultaneously, and that's an iron condor. The ideal circumstance, though, for doing that is to more or less have the strikes, both the anchor and the offset in each case, have it more or less equidistant from current price. Okay, and so if price kind of comes up here and it just kind of gets midway in between, depending on how the strikes lay out, this might be an ideal circumstance to actually have an iron condor. So we'll be keeping an eye on that because of the fact that, again, we're sitting roughly midway between price. Okay, so that's midway. The price is sitting midway between the levels. So that's the deal with Amazon. We take a quick look at Google here. Right now, this was an area of supply up here, right there. That's again a 2-hour zone there, and we can see clearly price came up and then dropped like a stone out of that after a brief amount of time. So right now, price has gone up into this, and it's kind of pierced it, and it's consolidated here for a day, and so I'm keeping this on, kind of keeping this on the radar, so that if in fact we do get some kind of bearish move on Monday, tomorrow, this could be the basis on a confirmation entry basis to actually then execute a bearish trade if in fact price drops out of here on a very, very bearish, if we're showing a very, very bearish candle. So if this drops to, let's say 115, no, I don't know, let's say 115.45, where it drops a quarter or so below this level, then in fact we might actually express a bearish trade out of this supply zone. Okay. On the other hand, if it just breaks through, then the next supply zone up from current price is about 2.25% up, and then down here in the daily chart, it's about 10% down. And if we look again in the 2-hour range, then there's a demand zone here that's sitting at around 8% down, okay, or about 2% above this daily zone. So depending on how aggressive we are, we can express a bullish trade either out of this 2-hour zone that's sitting here, or then the daily demand zone that's about 2% below that, which is about 10% below current price. So that's where we are on Google. Let's see. This is Facebook Meta. I don't really see anything interesting here. We're sitting right at the all-time high. You can see it certainly encountered some resistance here. And if we kind of go back again in time, this is a 2-hour zone. And again, price has been stopped by this level, but it certainly has not sent it back down. So this is just kind of consolidating up really near the, in fact, this is an actual all-time high here. And there's the 52-week high. So you can see it's kind of consolidating up here. On the other hand, if we get a breakout here, and particularly if we have a debt ceiling resolution, Meta could I won't say go to the moon, but you could really see a pop out of this. Because if it actually breaks through its all-time high, its 52-week high and its all-time high, and you've got a bullish market, this really has the potential to move. So we're going to keep an eye on Meta. Okay, so that's what we're looking at on Meta. If we take a quick look at Netflix here, okay, let's move that over a little here. Okay, so this is actually a nice demand, a nice supply zone here in the daily chart. So if we get a pullback up here, this would certainly be an area where we might consider shorting. Right up here, that's that jagged blue line. That is its 52-week high, just to give you in relation. So obviously this would be in a sense a counter trend trade if we decided to short this. Because we have made actually we'll have made then a series of higher lows, and then this would be another higher. This conceivably would be bumping up against a higher high. So we'll see whether in fact we do decide to go short out of here. Okay, so that level up here, if I just turn on the label here. Okay, so we're sitting here, and this is about an 8-point range here from 356 to 364. We're now sitting at 340 here, and then right here below. This was a prior area of demand. It's no longer valid because price rallied in here and then consolidated, then popped out of here. We then got a bounce out of here. So this has been chewed up because we can see price has gone in here, went through most of this level, and then it actually revisited here. So I would not be looking to go long out of here. Okay, so that's really the only thing that I really like in here, at least in the short term on Netflix, is a potential short that I'm looking at. And then the last thing is we take a quick look at our buddy Elon and Tesla. We then spread this out a little. Here's where we are with respect to various levels. So we're looking at the daily chart here again. This is a nice level of supply here. But in fact, you can see that Tesla's been a very, very volatile stock, and so if we look to see where we are in relation to current price, we can see where this is about 9% up from here. This near-term supply zone here, and of course, part of the supply zone is actually I was going to say there's a gap that looks like it might want to be filled. I guess it actually has already filled this gap. So but again, this actual clean area of supply, this is about 9% up. Okay, so that's what we're looking at on Tesla. And then right here, right immediately below here, though, there is an area of demand, and that's only 2.5% down. Okay, so in fact, this is probably the thing that I'm actually looking at in the short term here. And so in terms of executing some kind of bullish trade, I might actually adjust the front line of this demand zone down, and I would actually consider maybe putting it, in fact, a little lower right here. And so that at basically the origin of this small outside gap here. And so that's around 163. So looking at that, in fact, this zone would if we place that zone here, that's about what is that? About 2.9% down from from current price there. Okay, so that's where that demand zone is there. And then, of course, if we look much lower, we can see that there's a demand zone that's 14% down, and then a whole 20, and then it's 23% down. And again, those are these levels that are sitting right here. This is a drop, a base, and a rally. Here is a rally, a base, and a rally here. And of course, there's a big gap here. And so, in fact, this gap is waiting to be filled here. So, in fact, what we could do is, if we, depending on how this falls, this could actually be a breakout trade somewhere around here, and one could potentially ride that, let's say, from around 152 down to the origin of this big gap here, and this demand zone down to 144. So that's about an 8-point. That's about an 8-point range between this 152 and 144. So that might present itself as well in terms of a bearish breakout trade to the downside. Okay. So anyway, there you go. That's Tesla. So I hope you found all this information and looking at these charts interesting and helpful and potentially beneficial. Hopefully you liked what you saw. If you did, I would really be grateful if you would please give us a like on YouTube, subscribe to our channel, and also if you would like to schedule a call with either myself or my partner Ryan Nocera at Precision Trading Labs, please click the link that you see in front of you there, and we'll be happy to talk to you about how we trade, the whole supply and demand concept that I've went through here, as well as examine a couple of symbols that you might have of interest. All right. So at any rate, there you go. Thank you very much for the privilege of your time, and we will see you next time. Take care. Bye-bye.